Yeah, good afternoon, everyone. And thank you, RVO, for providing this opportunity to be, the presenter today on this little different topic other than the technical aspect of valuation. This is more covering the professional opportunities which exist when we are in this field. And since this is an RVO session, I believe the basics of valuation and other things we don't need to take through these the listeners. But what could be more relevant, that how this entire journey of valuation professionals have taken place in the recent past, and what is the likely scenario which will prevail in the future for this profession is what I thought we will discuss. Organizers, whenever you want me to take some break, please do let me know. I will stop for some time. So friends, basically this uh, profession has gone through a material change in the recent past. Once the definition of registered valuer was introduced in the Companies Act 2013, and after that the whole profession is getting more organized. It has become more wide for the professionals, and also in terms of the regulatory oversight also it has become more focused. So we are entering into an era whereby, not that in the good old days the valuation was not under any scrutiny or monitoring, but it has now taken a little more focused approach in terms of the valuers being under scrutiny. We have now this peer review mechanism of the RVO, which every valuer goes through. So there now, what are the challenges and how we need to gear up for this requirement, and which are the areas and which are the new avenues which are opening up for this profession? Let us discuss in few minutes. Now, before we straight jump into that topic, I thought we'll very briefly, for the benefit of everyone, we will just cover what exactly when we say valuation, what we exactly mean by valuation. And I know most of my friends in this particular session will be knowing this subject, but just to refresh our memories, that when we are called upon to do the valuation, what is our attempt? We are arriving at a value or the worth of that particular asset for which we are being, asset or liability for which we are called upon to evaluate, that what is the worth of this particular asset or a liability. So let's take an example. Suppose we are called upon to do a valuation of, say, shares. Now, equity shares of the company, when we need to value, we will value the whole company, and then at the end we will arrive at the per share value of the equity share. So in our report or our deliverable, we will tell the reader that this is, in your view or our view, the fair value of the equity shares of the company. So this entire process of going through the process of evaluating, calculating, taking a judgmental call, and then finally informing the user that this is your view about the valuation, is the whole process of valuation. And valuation, in if I go back to the history, in good old days was mainly used for governance purposes. For a very few requirement, it was a statutory provision which was triggering the valuation. Say, for example, in when companies like, say, Hindustan Lever and Tomco merged. Now, that time valuation was not attempted because it required any regulatory, trigger, but it was more so done so that the minority shareholders, when they are given the shares of the transferee company, there is an independent view about the swap ratio for which the valuers were called upon. There were wealth tax rules under which there was a proper formula, proper mechanism of registration of valuers under the wealth tax rules. All these were prevailing at that point of time. However, if you really see, the quantum of transaction was mainly determined by the governance requirement, and everybody wanted to be fair and transparent. So there was a appointment of independent valuers which were triggered. So to that extent, in prior to 2013, or maybe to that extent prior to introduction of SEBI, the valuations were more in terms of handled for governance purposes or for a specific transaction where there was a regulatory requirement. After 1992, when the SEBI was introduced and there were mechanism of approval which was introduced for any corporate restructuring, there was an oversight by the stock exchange, and that's where valuers were under more focus in terms of the whole exercise. And then we had this 2013 Act where 247 section was whereby registered valuation was introduced. So one is arriving at the fair value or a worth of a particular asset or a liability for calculating the value of assets or financial reporting or tax purposes. Nowadays, you must have observed and you must have encountered that when there is an impairment testing or under the Ind AS, if there is a fair value requirement, valuers are called upon. And then there is a complete review of the valuation by the statutory auditors, because ultimately they will be signing of the accounts using this particular data. So there will be a scrutiny or some kind of interaction which will take place between auditor of the company which has triggered this valuation and the valuer, who is an independent valuer. And then there will be, based on the discussion and final conclusion, there will be an impact in the accounts which will be given either for impairment or for a fair valuation mechanism if the company is doing a mark to market, or a fair value for the investments it is holding. There are also requirement of valuation for recording the transactions. Say, for example, a business is purchased or sold. So the acquirer of the business, suppose 100 rupees is paid for acquiring a business. Now, when the acquirer has to account for this business, it won't be the 100 rupees for business A to cash and bank balances. The entry will have to be based on various assets and liabilities which will travel through this business acquisition. They will have to be ascribed values. And finally, if there is anything which is left, which is the difference between the assets and liabilities for which the specific values are ascribed, minus the consideration already paid for the business transaction, the difference will go to the goodwill. But for arriving at that number, valuers are called upon, which is the entire exercise is called purchase price allocation. Many a times valuers also get involved for a due diligence exercise, not with a very specific carrying out the financial due diligence, but when the financials of the companies have certain assets which are not recorded at the full fair value, or they are recorded using certain methodologies, independent valuer may be called upon in the due diligence exercise to give a view about the value of the assets for giving a guidance to the acquirer as to what is the fair value. We are also called upon as a valuer many times for litigation purposes. Now, when two partners are fighting, there is a family separation triggered. So for all this purpose, the biggest question which plays in the minds of the litigating parties that what is the worth of the business or the shares you are giving up, and for that, how much is the consideration I should receive or I should pay. Now, for that exercise, valuers are called upon. In the recent past, what has happened, there are number of trigger points for valuation is also substantially increased. At the same time, number of professionals who are also involved in the valuation has also substantially increased. So earlier, I would, for want of better words, it was more like a monopoly of chartered accountants, whereby most of the valuations were done by chartered accountants because they were the first one to have this financial analysis, related work, and they were more dealing with the companies either as an auditor or as a consultant or with the families as a financial advisor. So they were always called upon first to carry out the valuation. Now, if we speak about today, we have so many other professionals also who are entitled to be the registered valuer, be it company secretaries, cost accountants, MCOMs, or MBAs. There are different criteria under which a valuer can register himself or herself as a registered valuer and then carry out the valuation. So it is not remained, a complete sort of informal monopoly as the case was earlier. with chartered accountants, but it is now so many other professionals also have entered into the field. So the field also has expanded recently. At the same time, professionals have also come in. Of course, in the real life, as we see, still chartered accountants carry a much higher weightage in terms of valuation opportunities as compared to other professions. Maybe as we move forward in time, there could be a different scenario where everybody will be registered under one roof. And I'll come to that particular proposal, which is also being discussed. So that in that case, again, there could be a slight different scenario which may emerge in the future years. Now, again, most of our participants will know about this, but just to refresh it so that when we go to the subject matter per se, we will have a little better understanding of the opportunities and what are the challenges lying ahead of us. So, as everybody is aware that when you give an opinion about the valuation, it is not necessarily that the transaction will also take place at the similar value. That's where we always say that there is always a difference between value and price. In very rare circumstances, we have seen that value and price converge with each other or are very near to each other. But in most cases, once the fair valuation is arrived at, thereafter it is there are a number of factors which affect the actual transaction price. It could be a distress situation of the seller. It could be a very aggressive positioning by the acquirer. It could be taxation reason. It could be some other negotiation skills. So, number of other trigger points may differentiate between fair value and the price. Now, another important point which is very critical in the case of valuation is that in a way valuation is a perishable commodity. It won't last very long in terms of its usability. So valuation done today may not be remaining the same, say after 1 month or after an event which takes place between valuation carried out and some major development in the statutory requirements or underlying enactments or some specific event which may take place in the company. So, say example, there is a fire in the company, and so if you have done carried out valuation on 21st June and say 25th June there is a fire in the company, the plant is shut, nobody knows what's the loss involved, whether you will get the insurance, to what extent you will get the insurance. So valuation done on 21st June may not even remain valid till 25th or 26th June because between the two dates some event has taken place and which has underlying value, it has changed the underlying valuation. Sometimes the regulation changes. Say, for example, sugar is not allowed to be exported. Suddenly there is a notification that now onward sugar will be allowed to be exported and there is a better margin possible in exporting sugar. Then the underlying valuation and the assumptions carried out prior to this enactment may be different as compared to what is the real likely scenario in the near future. In that case, also valuation may change. So we always say that valuation is a very date specific thing, and anybody using this valuation report, which is like a dated report, will have to take their own call, consultation, whether that same report he can use it for the purpose for which he is attempting, or he will have to carry out the revised valuation for the company because of the time lapse which has happened. Another important point which all of us are aware that valuation is more like an art and not an exact science. Of course, now there are methodologies which is having lots of logic, lots of backup, lots of market parameters which are possible to be used. So it is not remained as a pure art as we were like used to in the good old days, but now it has become more specific. In fact, now I remember in many conversations with the say, statutory auditors or any other professions, everybody wants to have a full backup of how this has entirely evolved, how a particular number has been worked out. So arithmetic also has been given an extremely high importance in the recent times. Valuation will also vary with the situation, and this is very important for valuation professional to know that if I am doing a valuation, say for a merger, say for example, Park Davis and Pfizer are merging. Now, if the requirement is to do the valuation for the merger, your ultimate deliverable will be giving a swap ratio. So for X number of shares of Park Davis, you will get Y number of shares of Pfizer. Now that's the final deliverable. Behind the scene, you may have number of calculations, lots of detail exercise, assumptions, all of that will be there. But your final report will just talk about the swap ratio. Another example for a specific situation could be a valuation for a demerger. Now, when it's a valuation for a demerger, the deliverable will say that for 100 shares of a particular company held by the shareholder, they will get 100 shares of company B. They will continue to hold the shares of company A, and they will also get additional shares of company B, because in a way the company has been now split into two parts. One division is being held in company A, another division is going to company B. In that case, your final deliverable will be entitlement ratio, as we may call, rather than a swap ratio, because you are not swapping the shares. You are giving ultimately an opinion on the entitlement of the shares. Another situation, specific situation could be you are called upon to do the fair market value calculation as per income tax. So Rule 11 UA will come into play, and Rule 11 UA has a specific formula given. So Rule 11 UA based valuation may not give you a fair valuation of the company in the real sense, but it also has defined in the enactment that it is called as a fair market value, and but there is a tight jacket formula which is given for that. In that case, you will have to state in your report that this is a valuation for the Rule 11 UA or for the income tax purposes, and that is how I have followed the formula which is prescribed. So it may not be the true fair value in the real commercial sense. So these are some of the things we have to keep in mind, because as a professional, we'll have to appropriately word our engagement letter, word our final report, and also a management representation letter which we take. Many times, if it is a vanilla demerger, you don't need to do the full valuation of the company, and you will just do a split of the company and just opine on the entitlement ratio which is being suggested, or which will be the suggestion of the valuer. So that's where you don't have to do the full valuation exercise of the two divisions. So these are some of the circumstances as a professional we'll have to keep in mind while entering into an assignment. Another important related point to that could be that when you take up such assignment, many times your time requirement to carry out the valuation will be very different. Say if you are doing it for merger, you will have to value both the companies. If you are doing for demerger, there may not be a valuation required. It will be more like a fairness opinion, or just opining on the entitlement ratio. If you are doing it for fair market value under the income tax and under Rule 11, your entire engagement letter time requirement will be different. So many a times when we are called upon to do the valuation, the first and foremost we should understand from the the client that what is the purpose for which they need this valuation. Because depending on the purpose, your time requirement, your staff requirement, everything will differ. Now, this slide basically covers some entire timeline under which this whole profession has moved over a period of time. As I mentioned earlier, where there was only wealth tax rule, where there was some mechanism of valuing the unquoted shares were prescribed. Thereafter, we had CCI guidelines which came in, which was mainly for helping to determine the premiums which were to be charged for the new issues. Then we have SEBI, which got introduced in 1992, and then thereafter under the FEMA regulations. FEMA regulation also has gone through a material changes as far as valuation requirement is concerned. FEMA gets triggered when there is a cross-border transaction, which could be for transfer of shares or issue of shares. Now, in few years back, FEMA used to just prescribe as per the erstwhile CCI guidelines, carry out the valuation, and that becomes either your floor or ceiling. Now, thereafter, at some point of time, I think 2010 or so, they said under the FEMA, if you have to do the valuation, carry out the valuation using discounted cash flow method. Now, thereafter, that also remained for few years, but then everybody realized that for every company, discounted cash flow method was not the right method. Say, if I'm doing a valuation for an NBFC or a bank, whether discounted cash flow method is the method under which this fair valuation under FEMA is an appropriate way to do. Some valuer may feel that it's not the right way, so they may use price to book value or other methodologies. So thereafter, the flexibility was introduced in the FEMA regulation, whereby internationally accepted valuation methods you may apply and then give your opinion. So that's why that also has gone through a serious changes in the recent past. But the path-breaking change, which according to me, which came into the regulation was to year 2017 and 2018, whereby the Companies Act, the Section 247 was introduced and registered valuer mechanism was being prescribed. Now we'll come to that slide exactly what is being asked from us as a valuer under the Companies Act and what are we supposed to do. But that changed the entire game for the valuers because the whole regulations, like accounting standard, valuation standards were introduced. Institutes RVO adopted the valuation standards prescribed by CA Institute. So all of that became a requirement and regulations for under which a chartered accountant who is registered with our RVO had to do this valuation as per the valuation standards prescribed by the CA Institute. So after that, lots of regularization of valuation profession has come through. Standardization has come through. Regulatory oversight has also become more organized. We have, as I mentioned, we have now a peer review mechanism where under which the valuation reports are being reviewed. You have regular reports being issued by the IBBI or RVOs about major findings coming out of those peer review requirements. There are also guidance available now for what you can use under the caveats, what you may not use. All these are now possible, which was not very specifically available under one roof or under a very specific guidelines. And that's where 2017-18 onwards, there is a far higher regularization of this profession. In 2020, there was the introduction of Valuers Bill. Of course, it has not yet seen the light of the day, but what was proposed there was a common institute of valuers. Like CA Institute, there was a plan to form Institute of Valuers, whereby all the people, all the professionals who are involved in the valuation were to be registered under one roof. And whether it is a land and building, securities and financial assets, or plant and machinery, all of that would be coming under one roof. However, this has not seen the light of the day. Lots of suggestions, I believe, have been given to the institute. Institute as well as Ministry of Corporate Affairs, and maybe going forward at some point of time, it will see the light of the day, and we will see an institute of valuers which will come in. Once that scenario comes, then a lot of duplication and other things which today we are seeing, and as we will see it in the presentation as we go ahead, maybe we will have a situation like that being avoided under the new regulation. Of course, one will have to see how the new regulation will evolve, because once the suggestions are given, which suggestions will get accepted, which will not get accepted, we'll have to see. But according to me, that will be another threshold after which the whole professional will go through a material change as far as the conduct is concerned. Now, as I mentioned earlier, Section 247 under the Companies Act was introduced, enacted, and then anybody wanting to do the valuation of property, stock, shares, debentures were required to be carried out by the registered valuer. Now, what is more important is subsection 2 of Section 247 of the Companies Act, which says that the registered valuer shall make an impartial, true and fair valuation of assets, which is fine. Second is it will exercise the due diligence while performing the functions as a valuer. Now, this is not a pure due diligence exercise as we loosely use for our professional work, that a specific due diligence is done. But what it means, in my view, is that you have to be diligent when you do the valuation exercise. So just somebody gives you data, and it's not, the requirement is not to just process that data and come out with a valuation, but requirement is to review that data, get satisfied that the data which is given to you appears to be reasonable, and then use that for your calculation. Third thing which it requires is the make the valuation in accordance with such rules as may be prescribed. And finally, this is also very important sub bullet, not to undertake valuation of any assets in which he has a direct or indirect interest, or become so interested at any time during a period of 3 years prior to his appointment as a valuer, or 3 years after the valuation of asset was conducted by him. The whole purpose of this requirement is to make sure that the valuers are independent and are not influenced. Suppose a valuer is also a tax advisor. In that case, there is a there is some kind of interest of that valuer in the particular company. He has, say he's a retainer in the company, or he is an auditor of the company, or he is a management consultant to the company. Whether it will be right for him to carry out the valuation, by the plain reading of this subsection, it seems that the regulation requires you to be completely independent, and they've given the timeline of 3 years prior and 3 years after the when you carry out the valuation. So it's not, they've not kept it open, that once you are out of the assignments, you may do the other professional work for that company. So having introduced this, the intention is that the valuer has to be, reasonably independent. Now there are different interpretation of this last bullet, which different firms are taking. Some people are taking a literal, sense, and if you have done any work prior to 3 years, they refrain to be the valuer. There are firms which have established their own internal guidelines of X percentage of the capital or X percentage of the total fees. Those kind of criteria they've kept, so that only if it goes beyond that particular threshold, then you are supposed to having a direct or indirect control. We do not have a very specific guidance on this subject available. There are certain law firms which have opined in a particular way, and I believe maybe in some future date we'll have a little more specific clarification which may come for this subsection. I believe there are some representations were also made. Maybe the next round of change, something more clear may emerge for this particular subsection. Now, as it happens, in the 2017, once the registered valuer concept got introduced, what was required was to also decide who will govern this entire registration and the disciplinary mechanism. The whole structure which got evolved was an IBBI, which was Insolvency and Bankruptcy Board of India, was given the task of registering the valuers and valuation registered valuer organizations, RVOs, and also monitor their performance, or if they find anything which is not fitting into the professionalism, they will have to do the oversight. So the whole mechanism of operation of registered valuer is that you have a registered valuer, they are registered with some registered valuer organization. So say our institute ICAI RVO is there. Likewise, there are about 15 RVOs. And I just, like last evening, I've just found out how many people are registered. So today we have about 15 RVOs which are registered. Registered valuer entities, that means under registered valuer, you can be an individual or you can register yourself as an entity subject to satisfaction of certain conditions. So if you are registered as an entity, so we have such about 110 entities which have registered themselves as a registered valuer. In terms of the overall registration of registered valuer under all the categories, because there are three categories. One is a plant and machinery, another is a land and building, and third is securities and financial assets. All put together, the total registration is about 5,569 as we speak. And out of that, for securities and financial asset, which is more pertaining to chartered accountants and people who have financial background, is about 2,205. In my view, this number is far lower than what it should be, because we have so many professionals who are otherwise doing valuation. Somehow they have not yet opted to become a registered valuer. And what could be the reason? Because as of now, there are certain regulations which allows chartered accountants and merchant bankers to do the valuation. For example, in income tax, there are certain trigger points where which valuation is either to be carried out by a chartered accountant or a merchant banker. Uh, Under the FEMA, again, it is chartered accountant or merchant banker. So those regulations have not yet changed. Today, it is predominantly being triggered through Companies Act requirement and for the SEBI requirement where there is a merger or a corporate restructuring which has taken place. In those cases, the valuation is required to be given by registered valuers. In my personal view, time is not far that for most of the requirements where valuation is the subject matter of discussion or scrutiny, they will ultimately require it to be done by registered valuers. So this number of 2,205 for securities and financial asset, although we may have say 10,000 valuers in the country, but only 2,205 have registered under that category as of now. But once the regulation starts changing under other acts also, I feel this number will go up substantially. Someone may get a feeling that because of this, the competition will increase. But today also that competition is existing. And they've opted not to register as a registered valuer, maybe because they want to just operate as a chartered accountant or a merchant banker and do the valuations and not touch any valuation which is required only by the registered valuers. And maybe then that means they want to get governed only by the respective institutes. So today, if I'm a chartered accountant and if I do a valuation which is not required to be done by registered valuer, the CA Institute rules and disciplinary mechanisms I will have to follow. IBBI regulations and RVO regulations I will have to follow only once I register myself as a registered valuer. So to that extent, maybe in the future we will have this number substantially going up. So as I mentioned, which are the different assets where a valuation could be triggered? Securities and financial assets, which will include your shares or any financial instrument, which could be preference shares, convertible debentures, non-convertible debentures, any financial instruments which requires a valuation will fall into first basket. Business. Nowadays we are seeing many acquirers are not comfortable acquiring a company per se. They are wanting to acquire only the business so that you don't touch the legal entity. There could be so many problems, old legacy issues in that legal entity. So they just acquire the business valuation. Now, intangibles valuations are required not only for accounting purposes, it's also required because nowadays lots of people want to use intangibles as giving a security to the fund providers. So to that extent, I'm seeing the requirement for intangible has increased substantially. Thereafter, land and building, plant and machinery are the other common areas. Another area for which valuations are also called upon is jewelry valuations, drawings valuations, patents, or any of those kind of assets are also being required to be valued. So you have a specialist of each of these categories, and you have number of people who are practicing only say in a particular segment. Say you have category of only jewelry valuers. They will not enter into any other field because their specialization will be only jewelry valuation. Likewise, you may find only people who are involved in only land and building. In that case, they will not enter into another field, even if they are eligible to register themselves into other areas because they want to maybe super specialize into that area. Now, this slide is a little more critical slide for us to evaluate that which are the opportunities or trigger points for us to get into a valuation profession. And of course, we are all into valuation profession being the members of RBO. But which are the different areas under which valuation can be asked? And before I go into that individual boxes, I also want to maybe stress upon in most of my interaction. I generally say that I have seen many times there is a reluctance by the valuers if they have not attempted say intangible valuations in the past. There is a tendency that they will not take up those kind of assignments. Now, friends, according to me, when we have the kind of degree which we are holding, and also the kind of training we have gone through to be a registered valuer. It is more than enough for us to be in the field of valuation of a particular category under which we are registered. So we should not shy away from entering into such assignment because there is always a beginning. I remember, years back I had visited the Nagpur for one, seminar, and most of the professionals during interaction, I realized that they used to say whenever we get a valuation assignment, we either give anything to a Bombay chartered accountant or Pune or Delhi chartered accountant. We never carry out our own on ourselves those valuations because we don't feel that we have the required competence. And I remember, sharing with them that it is not something which is a very rocket science. You can always, once you have a common sense and the requisite knowledge imbibed by our course, you can be in this field. And I'm happy that when I interacted with those chartered accountants, I realized that many of them have now ventured into this field and they are doing very well. So there is always a beginning, and the I'm sure when we take up any assignment and we do our own effort to understand the subject, we will not do any major goof up. There could be some slight understanding issue. There could be a subjectivity involved where there could be different views. I'm sure arithmetical errors we will not do. So once we have these kind of basic things, we can always make a beginning, and thereafter sky is the limit, because kind of transactions which have now started taking place, the more and more inflows are coming into the country. There is so much of development work which is happening. So many new companies are getting registered. You just imagine the kind of volume of valuation which is getting created, and that's why whoever gets registered will have the work going forward. So it is better that we enter into a field without any fear. Of course, it doesn't mean that you don't have to understand the topic and learn that topic. I always say that valuation, when you are into valuation field, you are more like a student rather than, you can't call yourself as a valuation expert, because every day we learn something new. You just imagine every day new industry comes to the valuer for evaluation. One day it could be cement company, another day it could be pharma company, third day it could be some service company. So every day we learn about new industry, about its own nuances, about the legal framework under which those companies operate. So it's a learning exercise every day. Another important trigger is that every day new instruments are coming with new conditions. Earlier, good old days, we had only preference shares. Now you have preference shares with so many further conditions that every instrument, when you sit and start evaluating for whatever accounting or a transaction purpose, you have to apply your mind, learn how this particular instrument functions, learn where is the waterfall mechanism going. All this, gives us a chance to learn something every day new. And that's where this field will never allow you to relax. This field will always keep you alert. Your brain will always continues to function. When you pick up a newspaper every day, your first attention will go about the various transactions which have taken place. So once you start getting into that mode, you keep on learning every day. Not that other fields of profession are boring in terms of assurance practice or taxation. They are also equally important and equally interesting. But I feel in valuation you learn a much wider gamut of things as compared to other professions, because of the sheer different types of assignments which you carry out during your professional journey. So with that, let us very quickly go through some of these trigger points which are mentioned in the basket. One thing, let me clarify, this is not an exhaustive list, friend. It is only something which is very commonly required or commonly a trigger point for valuation. So there could be another 10 boxes which you may be relevant, but for ease of understanding and for ease of discussion, I thought only more relevant and more frequently being required are covered. So under the business valuation, as I mentioned, restructuring, which could be for mergers, demergers, slump sale, subsidiarization, any kind of restructuring, capital reduction, buyback, anything which you are doing for their valuation will be a trigger. Suppose you are doing a capital reduction, you are doing a buyback of shares, if you are merging two companies, if you are transferring certain division to your wholly owned subsidiary, all these are trigger points for which valuation will be required. And as I mentioned, depending on the nature of the company, listed or unlisted, whether it will go to the scrutiny of the stock exchanges and SEBI thereafter, or it will be only a board of directors scrutiny, depending on the quoted or unquoted nature, we'll have to go through. Another thing could be purchase or sale of business, which we just discussed few minutes back. Third basket could be litigation or family settlements. Now, say two joint venture partners, they are not getting along and they want to get separated. Under the a joint venture agreement, there will be provisions of regarding valuations. Many joint venture agreements add about the names of the valuer. Three alternative names are mentioned. In some cases, it is only category of companies which are mentioned. In some joint venture agreements, it is kept open for the decision of the two parties, when the trigger event happens. And some joint venture agreements, it is by the chief justice of that state who will appoint the valuer. So there are different mechanisms for different kind of joint venture agreements for which there could be a trigger point of valuation. Only one point of caution: when you are doing a valuation for a litigation, be very clear about your role. Is it only just you are issuing a report and you're done with it, or you issue a report and you may be called upon as an expert witness? Because both are very different things. Once you issue the report and you are called upon as a witness, expert witness, it's an entire longer duration. Say arbitration, some matter is in arbitration. There could be cross examination. There could be questioning by the other side. So there could be a long drawn process. So when you are taking up such work, be clear about what is your nature of scope and how you want to place it. In terms of family settlements, generally, in many family settlements, it's not a very formal valuation which they call upon. They just call their family advisor and request him or her to carry out the valuation of the entire basket of companies or businesses, and then the patriarch or the some of the family advisor or family well-wisher will suggest them that how to you can separate the family. If I really look at the era prior to maybe 2010, we hardly had any family separations related trigger points. But now every month there is a new trigger point of family separation, because as the family expands, everybody wants to have their independent identity, independence, no interference, because of various reasons, temperament issues, ego issues, whatever we call, for which there is a separation which is required. And in a way, in the long run, it is good that instead of fighting and remaining under one roof, the family many times decides that let them be separated so that they peacefully go ahead in life. So I have seen some families, the patriarch decides much earlier in his life cycle to separate his own sons so that there is a clear understanding and there is no dispute at a later date. In some cases, they wait till the event of the departure of the patriarch and then they start, attempting this subject. It's different in different cases, and only care in the family settlement you have to, if you are appointed as a common valuer for all the parties involved. Say there are three brothers and all three have, come together and said you do the valuation. You have to really play a very independent role. You will not be able to take any sides and you can't be influenced by any brothers, because the kind of trust which they have imparted on you to be a common valuer for all the three parties itself shows that they are expecting a very impartial and independent view about the valuation of the companies or the businesses. So that makes the valuer's job very, very tricky and important. So that's where we have to stand up to such requirements and be fair. Valuation being subjective, however, I've seen many times you attempt a family separation related valuation, and there is one party who will feel that I have not been given a fair treatment. There are series of discussions which take place. You explain your case, you explain your logics, you explain your numbers, but still at the end of the day, you end up having some people who will not be very happy with it. Many times then they don't go ahead with the transaction, or many times they go ahead with the transaction, but with a little heavy mind. So we have to see the individual situation. Uh, the sum and substance is, as a valuer, we have to do our job in the most fair and transparent way and give our logic of a particular conclusion, and then ultimately it is left to the party. Many times fundraising requirement also will trigger a valuation. Say a company is going for a preferential issue of shares. If it's a listed company, there are certain guidelines under which it can be done. If it's an unlisted company, then one can do a proper fair valuation and carry out the valuation for the fundraising exercise. Many times funds are raised as a debt, and security is given existing shares of the company. Again, there the bankers many times will call you to do the valuation of share underlying shares which they are taking it as a security. Under the regulatory trigger, there are so many regulations under which valuation can be triggered. The most common, as I mentioned, could be under the income tax and FEMA, because nowadays we see so many cross-border transactions which takes place. And in those regulations, you need to have a valuation. Those valuers who are dealing with the listed company related restructuring work, they will also have to do the valuation which are triggered through the SEBI related regulations. Under the Companies Act also, there are a number of events under which the valuation gets triggered. It could be for ESOP, it could be for issue of shares, it could be for transfer of shares, it could be for transfer of assets for a consideration other than cash. All of this may require you to do the valuation. So if you really count, the number of trigger points have substantially increased even for the regulatory valuations also. Under the income tax, we have transfer pricing also triggering the valuation. For transfer of shares, section 56, rule 11 here. So many trigger points have been added for which valuation is called upon. For intangibles, I think more or less we discussed why we need a valuation. The last bullet there is about the impairment testing. Suppose you have recognized an intangible asset in the books. The auditor will insist on a regular interval impairment testing of that underlying. Say if it is goodwill, then he will ask you to do the impairment testing of the goodwill. If it is some other intangible, say patent or drawing or anything, and if it is not fetching the kind of return or the profits as it was expected, then they may ask for impairment testing. For financial reporting, we have seen number of trigger points. Many times, if you are say a fund at a regular interval, either quarterly or half yearly basis, you are called upon to do the valuation. Now, doing a valuation for a fund is more like I would say an annuity business, because every time there's a trigger of that completion of a quarter or completion of a half year, you will be called upon to do the valuation. It tends to become little monotonous, because only thing you have to, many times you have to just upgrade the numbers. But suggestion will be that whenever you are attempting, even on a quarterly basis, such valuation, look at it afresh, because underlying regulations could have changed, underlying business scenarios could have changed. A geopolitical situation may have changed the fortunes of the company, either which way. So you have to look at it afresh and not make it a very monotonous exercise of just upgrading the numbers. For financial reporting, again under Ind AS, and I think briefly I touched upon this subject, that when you carry out a fair valuation or impairment testing, the auditor who is ultimately going to give the assurance certificate will have his own valuation team get involved. There will be lots of to and fro which will take place in terms of data, and also there will be questioning by the auditor's valuation team to the valuer about various parameters which are considered. Now, when all this started a couple of years back, after introduction of Ind AS, it has become more intense. In the initial phases, I could see that there was some resistance by the valuer to deal with the auditors, because they were saying, I have done my valuation, I have issued my report. Now it is up to value auditor whether to accept it or not. But in real life, it will not work like this, because your client has appointed you for an accounting purpose. His ultimate aim will be to finally pass the muster of the statutory auditors. So there is no point, not discussing this with the value auditor and convincing him, because otherwise the whole purpose will not be solved. So I am seeing now the valuers have become more, communicative with the statutory auditors. Even within the statutory auditor field, also there is a clear guidance, under which they function. So to that extent, as long as you have used the parameters which are justifiable, and you not use certain, judgments which are without any backup, I don't see any challenge in that. Yes, for such valuation, you have to estimate little higher time, because most of our assignments we charge based on the time spent, and so it's not only doing the valuation, but there will be series of discussions with the valuation team of the statutory auditors. You have to also add those times before you give the proposal for financial reported relating to the value, accounting. Now, purchase price allocation, similarly, again, you do a valuation, uh, ascribe value to various assets which have traveled for that particular transaction, whether it's a business transfer or a merger. And then there will be, again, a lot of discussion with the auditors, because ultimately the statutory auditors will be okaying the accounting entries passed for that acquisition, and he will have to be satisfied. So again, when you do such exercise, you have to inbuild certain extra time for the discussions. Now, this slide, friends, with this August body, I will not, explain, because this was the basis under which we got our registered valuer examination pass. So I will not get into the different approaches, but this will remain in the slides for anybody to, refer it whenever it is required. Now let us come to the different opportunities as a valuer under different things. Again, just one clarification, friends. This is not an exhaustive list of opportunities, but more an indicative list, which are encountered in a professional's life. That which are the different circumstances under which you have to, you are called upon to do the valuation or do a advisory on valuation. So don't treat this as an exhaustive list. Again, as I mentioned earlier, there could be so many other opportunities for valuation, which may be for very different reasons also. So we'll treat this more like a discussion point rather than an exhaustive list. So to start with, first, once you are into a valuation field, the first and foremost is you want to be a registered valuer or a valuer, as the case may be, and you want to help your clients to carry out the fair valuation and opine on the fair valuation of a particular asset or a liability for which you are called upon. So that's a primary, I would say, the 60-70% trigger points generally when you enter into this profession will be for various regulatory requirements or various trigger points for which the client wants you to also independently give your view. Now, one fundamental thing which is when you issue a report for as a valuer, generally, unlike it is like a fixed formula, you generally end up saying that in my view or our view. If it's a firm, it's our. If it is individual, you will say in my view. In my opinion, the fair value of the shares is so and so. In our opinion, fair value of the business is so and so. Basically, it's not a net worth certificate whereby you may use the words like I hereby certify that the fair valuation of the company is so and so. Here it is an expression of an opinion by an individual. And as all of us know, if two individuals will attempt with the same kind of data valuation of the company, same data being provided to both of them, they will, in 99% cases, they will come out with different results to start with. So it is subjective in a nature, because there are so many places where we use our subjectivity, which could be either a discount rate or say a beta multiple or a call on a particular contingent liability. For all these cases, we use our own judgment, of course, with a logic. Don't use the parameters which are not justifiable. Because tomorrow, if there is a regulator which will come knocking the door, you will have to satisfy the regulator that this valuation was done with this so and so logic, and these are my parameters under which they were used. Just last week, I was speaking at ICAI for the Valuation Standard Board about documentation. So when you are carrying out a valuation under the regulatory requirement, your documentation has to be absolutely, up to date. Not that for other trigger points it is not that important, but for valuation which are issued for regulatory approvals, it is more important, because if tomorrow it gets challenged, you should have a file which is a speaking file, rather than remembering at that point of time, say after 2 years, when somebody calls you and asks you for a particular logic. Sometimes that particular employee may not be with you who has done the valuation. At times you will forget the underlying situation. So it is better that your file should be a speaking file whereby you maintain all the major parameters and logic being properly documented. So it's very important for a valuer to maintain the document as a backup if he is or she is called upon to explain to a regulator. Uh, Question may arise that how riskier is this particular valuation kind of a requirement when you will be called upon. So not every valuation gets challenged, and every valuation you have the regulators knocking the door. But yes, if there are certain parameters which are not fitting into the market parameters, or if there is some underlying problem in the company which you have valued, and say there is a loan default in that company after 2 years. In that case, there is a possibility that the regulator may open up the all the transactions which have taken place in, say, last 5 years. So in that case, even if your transaction may be an innocent transaction without any problem, but still once the regulator will open up for all the entire period, even the transaction which you were involved also may get covered in the scrutiny. So, we'll not be able to say that this is a field where you just give an advice and be done with it. This is one field when you are doing a valuation for a regulatory approval or for any accounting purpose or under SEBI regulation in financial reporting, everything, you will have to be more careful. Uh, yes, there are instances in the past where valuers are called by various agencies. There are cross examination. There are, sort of penal actions which are being taken on the valuers. So, in a way, as it is open for all the professional work, we are we are to some extent exposed to this regulatory requirement. And once you have done a fair job, I don't think so. It's more like a process you have to go through, rather than getting scared that we'll not do any valuation which is required for regulatory purposes. So that is valuers proper valuation role where regulation will trigger a requirement. Another requirement could be, you may be an investment banker, and you are a valuer, as a part of an investment banking arm. In that case, your role will be to guide your clients about M&A. See, because investment banker will do transaction on both the sides, purchase side, sales side. You may be guiding your client that what is the rate at which a particular shares can be bought, or what is the rate under which particular business can be sold. Those kind of guidance related valuation will be generally be done by investment bankers, because they will front end the transaction. They will also help the client in negotiations. They will also help the client in final documentation. So to that extent, role of an investment banker is not only for regulatory approvals. In fact, investment bankers valuation are generally not used for regulatory approvals. They will engage some registered valuer for carrying out the work, but for front ending the transaction with the third party, generally services of investment bankers are used. So it could be for mergers and acquisition. It could be for determining the value for the IPO pricing, or it could be for any other financial action. Another set of requirement could be, you can be into the private equity field, whereby you can be a private equity analyst. There, what will be your role as a valuer? You will help the PE firms to, again guide them about what's the fair value of the companies in which they are investing, and also for the regular updates about those companies and how it has impacted valuation on a time zone of say 0 to 7 years. Because every quarter or every 6 months, the investors of those private equity units will be required to be fed with the current valuation of the those particular assets which are being invested by the private equity arm. So many times, only once in a year they go to a registered value. I mean the professional valuer. Otherwise, they give their internal guidelines depending on how the terms are being decided. So to that extent, within the private equity arm, also there are valuers who are being appointed, and they also then do the full handholding of managing the portfolios which a private equity is invested in. You can be also, as a valuer, private equity managers, whereby you will do the whole strategization about how to invest in various categories, invest in various companies, and then play a role in little higher level of managing the private equities, and not only analyzing the data. So basically, there you will be answerable to the returns which you will give to your investors. So your role as a valuer, when you finally decide the strategy, will be very critical. Many times there are people who are existing from the marketplace are being playing this role as a private equity managers, and not the pure research analysts or the valuers who get into the private equity field. Uh, they also oversee the research, related papers which are being issued by the analysts. So, to that extent, the role of a private equity manager as a valuer will be little more onerous and little more responsible. You can be also financial advisor. Now, you as a valuer, then you can help your clients in making some informed investment decisions. Now, many times before the client goes to the investment banker, they have their own set of advisors who will guide them whether, what range this particular asset will come in. What are the risks attached to that particular asset? What are the opportunities which is in front of you? All this is done generally as a internal help is done by a professional or in-house professional or an external agency, and then you formally appoint somebody to scout for the buyer or seller. So role of the financial advisor also may many times get into the preparation of business plan for the target. It also maybe sometimes involve evaluating various impact on the valuation because of various events. Say geopolitical some event has taken place. These advisors typically will tell you what is the impact on that particular target which may happen. Another important professional opportunity is also opening up in the startup advisory, because every startup will not be able to engage within their own organization an internal analyst or internal valuer or internal managers. So many times they use an external agency. So you can be into the profession of advising only startups, where your role will be, again, starting from business plan, helping them for financial modeling, preparing the cash flows, preparing the internal valuations, then even helping them in negotiation. If they're raising the funds, what mode, what kind of different instruments, all of this as a startup advisory, your role as a valuation professional will be very critical. In fact, I'm seeing more and more professionals holding that startups, because it helps both of them. As a professional, you are not tied up to one organization, and for a startup, because it will reduce their cost of operation by not engaging with somebody with a fixed cost, but as a professional for fees. So many times it helps as a structure. Another important trigger could be you as a valuer can be, having a KPO, which is knowledge process outsourcing related work, uh, whereby you may be just helping some global firm for all their back office requirement of valuation. So many of these, firms located in United States or Europe, they because of the very costly staff, cost which they have, they engage with a valuation firm in India or other geographies, whereby they ask them to do some basic analytical work and some basic number crunching, and thereafter they will have people of their own who will do the front ending with the client. So the only flip side of this KPO is that many times you are only doing a desk job based on the instructions given by the underlying managers of those global firms, and you have no scope or no possibility to interact with the clients, because to the client they will never say that I am doing this work through somebody sitting in India. So they will there after represent their global outfit to the client. But I'm seeing a lot of valuation professionals are also choosing to go for this field because the pay packages are much better as compared to a pure valuation firms. There is some extra markup because of the nature of work and because of the global presence. That's why many professionals opt for going into the KPO. There is also now a new breed of valuation professionals who are also involved in financial modeling. In fact, I recently came across somebody from a firm whose visiting card mentioned that financial modeling, vice president financial modeling. So once you get into the details, that what exactly you do, it's more to do with the entire head loading of business plan related work, the various assumptions, the whole model is being created by them. Again, then thereafter, generally it is handed over to a valuer or any other professionals like investment banker, and the whole interaction with that professional also happens through this financial model, professional. So it is another kind of category which has got created. I don't remember this category being in existence in good old days, because same valuer or same consultant was doing the entire basket of activities. But here with this new area which is being opened up, you see that very focused attention. So you have people who are extremely competent on the Excel skills, their calculation mechanism, your different models for different instruments. All this, there is a high level of specialization possible. Again, generally, these people who are involved in the modeling will not be involved in actual valuation because there could be a conflict of interest. So their role will end with the preparation of the financial model, and they are many of times they are quite detailed. Different scenarios are also being presented. Just a minute. Another opportunity which for the valuers which have now come up in the recent times, again last 5-7 years, is engaging themselves with the family offices. Role is something similar to what the private equity analyst will have, but these are very specific. The number of investment will also be less. The mechanism of oversight is also less, but they manage the entire family's investment opportunities, and then they guide the family board as to where the investment opportunities are like, and again monitoring of all those investments made by the family offices. So category wise, they are more or less similar to the private equity analyst or private equity managers, but in terms of size, it could be slightly lower because family offices will have typically a lower size of volume. In terms of family settlements, as we discussed briefly, in the earlier slide, uh, this is a huge opening which I am seeing in the recent times, the last 1 decade, the kind of family settlement related work which is coming up. So there your first trigger point of any family dispute or any trigger of family settlement talks is the underlying valuation, and that's why valuers are called upon first. Another added service which a valuer will have to maybe also get involved, maybe not very actively, but also as a hand holding, will be finally structuring the family settlement document. Because when the document is being prepared, say by a law firm is preparing the documentation, the person who has underlying evaluated the businesses or the whole companies, their inputs will be very critical for them to put certain conditions, certain non-compete related things. So that's why typically the whole, when you get involved into a family settlement, it will not end with only valuations, but it will also end with further, require professional requirements, which could be documentation related advisory as well as structuring related advisory also. After COVID, many people started realizing that we need to have a proper succession planning in place. Many of the industrialists were not very, active in preparing their, family succession plan, whether it could be a private trust or a, will. Uh, and everybody started realizing that, it could be, a far important requirement in their lives. So again, last 4 5 years, I'm seeing that people triggering the succession planning related work. And again, while doing succession planning, valuers are always called upon, because, so say an industrialist having multiple businesses is attempting a succession planning, and he has say 3 children. He will have to then first evaluate the businesses and understand what are the broad valuation range of each of these businesses, and then further plan the succession. Otherwise, you may be doing injustice unknowingly also at times. So generally, they engage with the valuers. Again, here also, succession planning will not end only with valuation. You will have to get involved in the handholding exercise of finally implementing the succession planning document. Maybe the actual implementation is done by other agency, which could be another advisor or it could be another law firm. But you will have to get involved till end, because you started the process with evaluating the businesses or companies. Ultimately, it will have to see the similar language in the document also. So generally, once you get involved with such assignment, you will ultimately, get involved with the entire leg of the transaction and not only partial involved. Now, many of the sessions like this, it is asked that, if you want to be, we are valuers or we want to be in the valuation field, but what are some of the things which we'll have to do, in terms of reaching that extra mile? And that's where I thought, let me just add some points and put it for discussion with the valuation professionals. First and foremost, according to me, when you are in the field of valuation, you can't say that what is happening in the world, I'm not aware. So, continuously keeping touch about the financial world, that what exactly transactions are happening, what was the structure of the transaction, what was the consideration paid. Unless you know this, the next time you are valuing the company of a similar nature, if you have not read it, you may ultimately end up, not taking cognizance of the real life situation and may become more theoretical. So reading of the event, which could be through either variety of sources. That you have now so many websites which are giving the deal related details, stock exchange announcements, which are now quite elaborate when there is a acquisition or a transaction which takes place. So you have to have a very disciplined approach of making it a habit that, every day, maybe at the end of the day, you spend some time in, finding out what are the different new announcements which have come today, and maybe when you look at the newspapers of the next day, just, going through some of the major transactions which may take place. So it's very important for you to be up to date on the field of reading. Basically, there could be lots of reading material. So many times valuers, we get confused at what to read and what to avoid. There are certain good books on the valuations which are also available. Some books are by foreign authors, some books are published by Indian houses. So you may, depending on your need and depending on the gap in terms of the understanding, you may choose a particular book. Uh, it is also important for you not to read only books on valuation, but say certain developments in the taxation field. Suppose, some few years back, goodwill, the depreciation on goodwill, there was a change in the income tax act, and it was not, allowed for those depreciations which arose out of only an accounting treatment of goodwill. In those cases, if you have not read those, articles or the judgments of taxation department, you will not know what is happening in the outside world, and you end up advising something wrong or concluding something wrong. There are a lot of research papers which are available. So if I'm valuing, say, a cement company, and there are 5 research papers available, generally you don't get heavily guided by those research papers, because some of these are issued, for in-house consumption and other things. But at least you have a look at it. Some of the important aspects which they would have covered, maybe you had missed it, or some of the way of thinking of a research analyst could be different. So it's always better for you to have a look at those research papers. But my humble suggestion to the group will be that not to get heavily guided by those research conclusions. So somebody may say company A will be 1,000 rupees after 3 months, but it is not necessarily that you have to be guided by that for your arriving at your fair valuation today. They may have used certain other parameters. Some of these research analysts also use chart related conclusions. So it is possible that your views may not agree with those research papers. Generally, I insist that you use the research paper just to make sure that factually you have not missed any point. Sometimes unintentionally, company may not give you any information. Unintentionally, I'm not saying intentionally, but giving them benefit of doubt, unintentionally they may not divulge certain information which may come out with the research paper. Now, another very important source of information about the company is also all these investor related calls which the companies make. Nowadays, you have transcripts also available, and audio recording are also put on the websites and the stock exchanges. It's submitted to the stock exchanges. Sometimes those interactions gives you a very great insight about a company. Now, let me just give you an example. That you are given a set of projections which are, say, very rosy. You just 15 days back, the company had an investor, call with various analysts, and if you hear there, the managing director had made certain statements which are quite, depressive in nature. In that case, you will realize that the kind of call which was there 15 days back by the person who is running the company, and somebody who has made the projections are totally different. They are not speaking to each other in terms of the data is not matching with each other's views. So that's where you can question that. So we have now lots of data available for reading, various valuation standards, valuation guidelines. So you have lots of material which is available. With the thanks to the internet, you have data which is over flooded. But you have to also be little selective, because at times I have seen the valuation professionals spend so much time on the irrelevant information that finally the deadline will arrive so fast, and you will not be able to conclude on the valuation in time or give that kind of quality which is required to be given. So just be very selective in terms of what you want to read and what you don't want to go into the details, and make that judgment. Otherwise, it is possible that a 7-day assignment or a 10-day deadline assignment, say 8 days you will spend in reading something which is not very relevant to the company, and then having only 1 or 2 days for final analysis and conclusion. So be very careful with this kind of data which is available. Market research related, we have no choice. Now we have started seeing so many annual reports which are being published, because AGMs will start coming in. Some of these annual reports are quite well informative. Say you are valuing, again, for the want of better example, so you are valuing a cement company. So and you have a annual report of another cement company. The management and discussion analysis about the strength of the industry, the challenges which are faced by the industry will be visible there. So again, you can get certain insight from a competitor also. So different market studies, market research report also many times you have access to. Then you can use those for your internal analysis. I mentioned to you about NSE and BSE announcements. Again, you will have to filter it for the restructuring and other one. Otherwise, every single announcement you start looking at it, lots of time will go into it. Sometimes you have benefit of industry reports. There's some market research report on a particular pharma product or a pharma industry you have, or a particular sunrise industry you are looking at, in some research report is already published on that. Again, when you read such reports, don't blindly follow these reports. They may show you some growth, which could be academic growth also. They also, there will be some kind of assumptions behind those reports or some kind of motive of preparing these reports. So you use that data, but filter it to the extent required, or unless you are satisfied, don't use it blindly. Sometimes real life case study also will help you to understand this subject and become more stronger in the topic. When you analyze a full case, say why Tata's acquired Tetley's, you analyze that entire case. There's so much of material available. Financial reports of all the years after the acquisitions are now available. You can do this entire analysis and come out with a case study that after acquiring and say paying £100 for that acquisition, how much within what time Tatas could recover back those amounts, how it affected in the initial phase the acquiring company. All of this can be used as a case study, and you can do your analysis. It will help you in your future professional life when a similar case will come for your review. Regulatory updates we'll have to continuously monitor, because some law may change, somewhere a tax judgment may come in place, somewhere GST rate may change. All these could impact your valuation. So you have to be more and more vigilant about what are the regulatory updates about that industry or a particular company as a whole. Sometimes companies are heavily influenced by RBI regulations. In that case, you will have to continuously monitor. Say it's an NBFC and systematically important NBFC. In that case, you will have to see the guidelines or changes which are coming up under RBI regulations. Sometimes you are looking at SEBI related changes which are coming up. Few years back, SEBI introduced a format of the valuation report. They said that this particular table they need in the valuation report. What was happening in the prior to that, valuers were just writing the swap ratio, that for X number of shares of transferor company, Y number of shares of transferee company will be issued. Underlying workings were like available for a confidential filing, and only when there is an inquiry or something where there was a required, either a condensed workings were provided, or detailed workings were provided only on a particular order of a regulatory authority. But now what SEBI, few years back brought into a change through a circular, that when you are issuing a report for corporate restructuring, you mention under income approach what is the value per share, under asset approach what is the value per share, and then the whole report format got changed. When the registered valuer rules were introduced, certain points under the caveats and disclaimers were not allowed to be written in a very. So in many valuation report in earlier times used to just say we have not reviewed the projections, we have just taken it and done the calculation. More or less, not exactly the same wordings, but more or less giving that impression to the reader. Now, what are we required to do? And as we saw in section 247, subsection also, you have to be also diligent. You have to also do your own analysis, and you have to also find out whether the assumptions which are given by the company are fair or not. Suppose you are using another valuer's report for land and building. I have engaged with some other registered valuer, and he has submitted a report. What is required from the main valuer is also to review the report of that sub valuer, which is for say only land, and make sure that the assumptions carried out by that valuer is reasonable or not. Now, sometimes it throws a lot of challenges for a financial valuer, because that kind of data is not available with you. Now, you will not know what's the per square foot rate in Calcutta which is operating. Now, this valuer has given the report to you. But you can now, with the available data, internet, you can find out some broad range, whether it is fitting into an overall, reasonability test or not. As I mentioned few minutes back, now, we have to also learn about various new instruments and how they will be valued. So that's why this field has become very interesting in the recent times, because, plain instruments, very few people are issuing, like say just equity shares. Here you have now convertible debentures, optionally convertible debentures, redeemable preference shares with certain conditions. All these are possible, transaction mechanisms. And once you are part of the, valuation team, you will not be able to say that I value only equity shares. I don't do the valuation of other instruments. So there is a learning process which is required to be carried out. Now, I will not get into too much detail about under different laws, which are the trigger points, but as I briefly mentioned, under the income tax, what are the trigger point for valuation? Under section 56 to 7B, section 50B, for transfer pricing, section 92, for indirect transfers, for ESOPs, there are different trigger points under the Income Tax Act. And as I mentioned in the somewhere in the rules, they have also prescribed the formula. These are slides which are more like a detailing slide, not connected to the valuation opportunities per se. But yes, for income tax also there are so many trigger points for which a valuer may be called upon. Under the Companies Act also there are so many trigger points. I think my last count was 17, if I'm not wrong. Different sections under which there is a requirement to do the valuation by a registered valuer. Now it could be for sweat equity of shares, issue of shares, convertible securities, for purchase of own shares, which is buyback, or transaction involving transfer of assets without consideration, or by issue consideration is issued by way of issue of new shares. All of these are triggering the valuation under the Companies Act. Section 230 for any scheme of amalgamation or demerger or any restructuring. Cross-border mergers, 234, 236 for purchase of minority shareholding, under section 281 for winding up of the company. So there are different trigger points under the Companies Act also, which requires you to do the valuation. Under the FEMA regulations, you have issue of shares or securities by an Indian company to person who is resident outside India. Say today you are operating a private limited company where current only Indian promoters are holding 100% shares. Now you have called for a partner and he is coming from, say, USA. He is investing in new shares or he is buying over the shares of the existing shareholders. If it's an issue of shares, also there is a valuation required because there is a foreign exchange which is coming into the country. Again, if it's a transfer also, there is a foreign exchange which is coming into the country. So FEMA regulations will trigger. If there is a transfer of shares, by foreign parties, to an Indian party, then again foreign exchange will go out of the country, so FEMA will get triggered. When an Indian company is acquiring a shares of a foreign company, again FEMA regulations and valuation requirements will get triggered. Of course, there are other trigger points like preferential issue, rights issue, and other things, but these are major ones which will generally trigger under the FEMA different requirement for valuation. Now, many times these questions are asked by either clients or within the valuation fraternity, that there are so many requirements where under different act, different person will need to do the valuation. Say, if you take an example of issue of shares, under Companies Act, the requirement will be by registered valuer. If it is a SEBI related things, independent registered valuer, again same. FEMA regulations, either chartered accountant or SEBI registered merchant banker. Income Tax Act, merchant banker, again for under section 56, or a chartered accountant for other purposes. Now, many times smaller companies find it very difficult because they will have a chartered accountant who will do the valuation maybe under income tax, or a merchant banker who is doing valuation under income tax act, but he may not be a registered valuer. So Companies Act, again, you will need to get to somebody else who is a registered valuer. So they find it very difficult that, we have to engage with 2-3 professions. But as I mentioned, this could be a temporary issue. As the Institute of Valuers may come in, in near future, ultimately at some point of time, whether it is within 3 years, 5 years, 2 years, we don't know. It will converge that everything will be done by persons who are registered with the, say, Institute of Valuers. Like CA membership, we will have a valuers membership number. And only if you have that membership, you will be able to do valuation under any statute of the country. How far we are from that situation, it is anybody's guess. It could be as soon as 3 years, 5 years, 2 years. Only challenge which such institute will throw up for valuers will be, and question which was asked when the valuers bill was also introduced, whether we have to go through this entire mechanism of doing any course and appearing for exam again, or it will be straight pass through of, if you are a registered valuer, you are straight will be taken as a member of that insured. Again, we will have to see the regulation as it comes, but that will make life of regulators also little easier and valuers also little easier. Challenge will be that if you are a chartered accountant and doing valuation, whether you can hold the membership of both the institute, or you will have to give up your normal CA institute membership. We don't know again what kind of requirement will throw up. It's anybody's guess, so we'll have to wait and watch. But the whole trigger point of valuation by different category of professionals to the corporate world, it has thrown up a variety of challenges in terms of higher cost of doing the transaction and also dealing with different professionals. It takes away a lot of extra time and it throws up a lot of challenges for them. So in the corporate world, this is not something where they will be able to hold on for very long. I'm sure through their CII and FICCI, I'm sure lots of representation must have gone, and we'll have to see when this new regulation will see the light of the day. Lastly, before we end the presentation and maybe open up for some discussion, could be some other minor points, but for the valuer, sometimes it becomes a very major challenge. And in many seminars and conferences, these questions are asked that how to deal with such situations. So I thought very briefly to touch upon each of these boxes, which could be important for us as a valuer to address to it. Now, one very common problem which valuers today are facing is the timeline related issue. Now, there are promoters or there are professionals who will come and say, I need valuation in 1 day, 2 days, 3 days. Always a question is being asked that where should we take up such assignments or not? Again, answer is not that plain and straight. What you need to also assess is your capability to take up those new assignments, your capability of the team building which is available with you, and the kind of quality of data which will be made available to you. Suppose there is a data room which is provided. You also have a very strong team available with you, and you are confident of the kind of nature of work which is expected from you in terms of the deliverable. You may do a valuation in a little shorter time frame than a normal, say 2 weeks or 1 week, what you are taking for other assignments, subject to this availability. But in real life, I've always seen that timelines are always very tight. Client will come with a very short timeline, and we have to ultimately take a call whether it is possible or not. Now, I remember sometimes speaking at a conference in Delhi, our office. Somebody got up and said that, ultimately we are building up this practice. How can we allow the transaction to go from our hand? And the person was right, because if he's building up the practice, he has to be little flexible on the timeline. So many times I've seen, the professionals take up the assignment for such short time, this thing. Only care you have to take is that when you do an assignment in the short time span, it is not at the cost of any documentation or a logic or a quality. Because after 2 years, if some regulator will call you, you will not be able to take a plea that, I was given only 2 days, 2 days mein to itna hi kar sakte hai. All those arguments will not work. So regulatory oversight being very tight, it is the valuer who will have to take a call that if somebody calls you to do the valuation in a particular time frame, you will have to take a call whether you are geared to do this in a particular time frame. Another problem is that many times valuers are called upon that we have done the transaction and we want 100 rupees for this per share valuation. Now again, valuers keep on debating whether we should take up such assignment or not. Mostly these are for regulatory approvals. You attempt the valuation, it is not fitting into the range they have agreed. Questions are, should we give up the assignment? If we tell at the last minute client that I will not be able to give, they get upset. How do we deal with this situation? So when you take up such assignments, if at all you take up such assignment for only regulatory approvals, that whether it is 100 what they've agreed commercially, is it fair or not? You have to be very clearly expressive to the client that I will attempt the calculations, and if I don't come near to that range, I will be able, it should be possible for me to walk out of the assignment. Because at the end of the, say, for a 7-day assignment, at the end of 6th day, if you realize that you are nowhere near 100 rupees what they've agreed, it is better for you to, not succumb and, use certain parameters which are not justifiable and give that kind of result. Because again, as I mentioned, at the cost of repetition, when it comes to regulators, you will not be able to take a plea that commercially तो वो लोग ने agree कर दिया था, मेरा तो regulatory approval के लिए fairness opinion था. तो you will not be able to give that kind of answer when you are called upon by the regulators. Many times, people prefer to merge with a larger practice of valuation because sheer volume increases. There is a better training possible, better benchmarking possible amongst the staff members. So many times I've seen people opting and, getting into a larger valuation firms rather than operating on individual basis. Say 10 individual valuers operating individually will have, say, 5 assignments a year. But if all of them are together, they may get into a very good volume, and more so from a volume perspective, instead of volume, more so from a training perspective, from building the staff perspective, it becomes a very easier, possibility. Many valuers, subject to their respective institutes' guidelines, they tie up, either have an informal tie-up with either different investment bankers, different lawyers, different CA firms, that whenever they have any assignment of valuation, they generally pass it on to them. Of course, these are not very formal types. These are more like a customary calls, as we may call. And generally, they are into that preferred valuation list, because even that professionals, if it's a lawyer, if he has a comfort with a valuer, it is better for him to go to the panel with whom he is comfortable, rather than introducing for the transaction completely a new valuer and starting the process. Many valuers have now started also connecting with the global valuation firms, and one of the option is to do their back office work. Second is to also do a full even front ending for their Indian clients. So, if there's a global valuation firm and his client is coming to India for investment, the whole front ending in India is done by the Indian firm. And that's where only this happens when they have a tie-up. Again, one has to be clear that whether your respective should allow this kind of a tie-up. Multidisciplinary firm is being, model has been being discussed for some time. There are guidelines which are being disclosed, discussed, subject to restrictions. Now, two different set of professionals of a different background may come under one roof, and with certain conditionality can function under one single firm. I think still the field is still evolving. I don't see it is being fully matured. People have yet to, test the, success of such, such models. But again, going forward, it will help, because suppose in a valuation, I need land and building valuation also, I need plant and machinery valuation also, I need a financial valuation also. If the client has to deal with 3 different firms, for him it becomes very difficult. But if all the 3 professionals are sitting under one firm, under one regulatory, one disciplinary requirement and one leader, it becomes very easier for the client to handle with all the 3 valuers and get his work done. So it will evolve over a period of time. Friends, we have not gone through a history of a very long professional life of valuers. So I would feel that we are still evolving. We are still far off from a matured stage of profession. So in a way, I would still call it as a sunrise industry. It is not yet fully matured and fully, even from a regulator perspective, they are also many times not clear. Sometimes new officers of a regulator comes and they are asking some basic contour of the transaction because they don't understand the subject. Even they are getting respective trainings. Even valuers are also getting through a training mode. And I'm sure time will come going forward where the industry will become more matured, profession will become more matured, with a more better, possibility of getting trained, and better possibility of engaging it in a much more organized way as compared to what this profession is being operated today. One last thing about, many times these questions are asked that when a regulator calls upon you, what care one should take. So when a regulator calls for any scrutiny or valuation, of course, we have to keep in mind that sometimes it becomes a scary experience, because they start with a very aggressive tone, they start with a very threatening kind of a situation. Maybe that's how they are trained. As long as you have done your job properly, you have your own logic. Valuation being subjective, you keep on noting down the points which are very important for them to understand. It will happen that after some time they will also understand the strength and the deepness with which you come, as far as the subject is concerned. Maybe your background will be examined by that time, so you will find that kind of little more toned down approach after some time. But yes, friends, sometimes to start with it becomes a little scary. They come out with various consequences which may make it a little more difficult for professional to digest, because we are not used to going through this mechanism. There are a number of instances where valuers are called upon. Unfortunately, what has happened, something goes wrong in the company, the first people to be called are valuers, auditors, advisors, and thereafter finally they call the promoters. So first round of scrutiny is professional. So it is again, going forward, it may get changed. First, let the real culprits be caught before the professionals are being arrested. But it is still again, newer aspects are getting introduced. So even at a regulatory level also training is going on, so maybe that also will become little more matured approach. But documentation, your reasoning, your file notes will always help you when you've done a work. And nothing to be extra scared of. Sometimes it happens that the right answer is also not remembered when you are being questioned. So that's why keep the proper file and proper notes in place. Study the file properly before you go for such investigations, because many times you may not be given access to the files. Maybe many times you have five people interrogating you, and you are alone on this side. All these situations come, so you have to be little more extra prepared for the case. Many times you are called after a few years, so you have also forgotten the situation. So it's better to take some time, study the file properly, and then go for such investigation. So it helps you to also justify the case. Even on the regulator side also, you will find that the person will understand that this person has done a thorough job. So we'll have to maybe attempt towards that to ultimately go through this exercise, which at times becomes very painful. So I think, friends, I have nothing further to add on this profession. If organizers may just decide, if they have if they feel there's some extra time, we may take up some points for discussion.
Sir, there are still a few more minutes to go. So, in case there's something that you would like to share with the participants, we would welcome that, sir.
Yeah, so if the participants have any further questions, we may attempt to address that. Otherwise, we'll take up some topic and maybe further elaborate. So you have any questions with you?
So, not at the moment.
Okay, fine.
The participants have the option to raise any questions they have through the question box. So, in case you have any queries for Sujal, sir, we request you all to kindly raise your queries through that box, please.
Maybe yeah, till the time you get that, we can cover the aspect relating to uh, the oversight, from the RVO side as well as the IBBI side, where which has gone through in the past in terms of peer reviews, and what are the different findings which have come. Because I think many times it happens that the professionals are issuing the report, but without realizing that certain uh, uh, requirements which are must to be mentioned are missing from those things. So we know just few minutes on that. Let me spend before we have some questions. So as you know, there are valuation rules and there is a content of report which is mentioned as a part of the requirement, that what are the basic things which a report must state. And if you go back to the report writing, when I started my career, we had valuation reports which were as short as one and a half page and as long as 100 pages. So not that those were not correct reports, but those were the practices followed by different professions were following different practices. So some people were writing in a great detail, some people were writing in a condensed form, just writing these are the three methods used and this is the conclusion. So now what has happened again post 2017-18 time, 2017-2018, whereby we have now a very clear guidance about what should be the minimum contents of a valuation report. So some of the basic things which have come out from a peer review findings report, once the reports were reviewed and some of the findings were published, some of the basic things which came out, like valuation date. So the date of valuation which is required to be mentioned were missing in the valuation report. So whether you have done the valuation as of 31st May, 31st March, 20th June, valuation date needs to be mentioned. Secondly, many times valuations reports were silent about the methodologies which were used. So they will write about one of the methods and say based on other parameters used we conclude this way. So the details about various methodologies used, or if a particular methodology was discarded, say for example I have not used discounted cash flow method for some specific reason, it is required for us to discard those methods and write that why we are not using a particular methodology from that particular approach. So it is, those were the things which were not mentioned. Another thing, the basis of valuation was not mentioned, whether it is going concern valuation or fair valuation, whatever. Those were missing. At times, there was some mention in the report about valuation of an instrument, say preference shares. But what are the major terms of the particular instruments were not mentioned in the report. So you just say that 7% preference shares, but 7% optionally convertible preference shares to be converted in the following conditions with following timelines. Because unless the reader has the knowledge of that, whatever you have written thereafter becomes little difficult for him to digest, because he is not even knowing the basic terms of the instrument which is being valued. So it is required for the valuer to write about the details about the instruments which were missing in some of the reports. Another thing which valuers and I think this is a much debated topic, and I'm sure it will further get refined, is about what we write as a disclaimer in the report. In fact, general feeling of the regulator is that we disclaim so many things, which are otherwise not fully acceptable as far as they are concerned. So, I mentioned to you during my discussion about the projections related reviews. Certain, certain times the transaction related details where the valuers had disclaimed. Sometimes, we write that we have not reviewed the data which was provided to us. Now in old times the valuer used to write that I have not done the audit or any test of the data which was provided to me. Now with this specific requirement to be diligent, at least you have to see this data, make sure it is reasonably fitting into the parameters, and then proceed on that data. It is not expected for you to do assurance of that data, otherwise it will become like an audit practice. But what is expected is that suppose somebody has given you detail about, say, surplus land. Now, surplus land, somebody has said that you have 50 acres of surplus land. So, some basic questioning that whether these 50 acres are easily sellable within the factory, are they under one location or different parts? All these are some basic questioning. What is the general prevailing market rate in that area? Many times, as I mentioned, we have used the other valuers report. Some basic questioning to that valuer about the assumptions being taken by that valuer All these are something which are now expected to be. It is not something where you disclaim everything and say that I have gone by what is data which is provided to me. On the projections front, there were so many debates in various even meetings where to completely give a blind disclaimer that we have used the projections as provided by the management and done the workings. Now those kind of wordings are not now acceptable in the caveats and disclaimers. They want a basic mention that you have done the reasonable assurance of the assumption, sorry, reasonable review of the assumptions, and you are satisfied that the assumptions which are used for the projections are appear to be reasonable. So this was one more aspect. In one case, I somewhere I had read in the report issued by the RVO that the valuer had some constraint about the data. Say last audited result was not provided. Now, somewhere indirectly it was mentioned, but the fact that it is a matter of concern and it needs to be specifically be drawn the attention of the reader. So, instead of just writing in sources of information that I have relied on the balance sheet of March 23 and not March 24 if we are doing the valuation in say June 2024, to assume that the reader will understand that I've used an outdated balance sheet may not be correct situation, because this is an item which is critical to the valuation and it may change the valuation result. That's why it is better for you to specifically write about the constraint in any valuation exercise. For whatever reason the balance sheet was not provided to you, either for some regulatory reason, the offices were sealed by the regulatory authorities and that's why there was no access given. All of that could be a correct reason, but please state that in the report and say that I had so much of constraint on these three items, and that's why my valuation report should be read in conjunction with those constraints. In some reports, even the engaging agencies were not mentioned. Details about engagement letters were not mentioned. Now, one little side subject about engagement letter and management representation letter. Now, typically, what happens when a valuer is doing the valuation, he will take a management representation letter, summarize all the points of discussion which have taken place in last say 15 days when you were engaged in the valuation exercise, and generally we only as a valuer suggest that these are the things should be covered in the MRL and it should be provided to you. So typically your valuation report dated is 21st June, your MRL management representation is dated 20th June or 21st June also in many cases. So in some of the regulatory inquiries, it came up that how can you do the valuation using only, just one day? Because in the management representation letter, all the data provided is also mentioned. All the clarifications are also given. So the regulator said that your management representation letter is dated 20th June. How you have done valuation within one day and have carried out and issued the report on 21st June? So that's where, there you have to educate the regulator that how the process works. That you start collecting the data, you start making notes, and finally it is put under one, letter so that everything under, where you have relied on a particular data is provided, is under one single, because there could be minutes of so many meetings or some calls which you would have taken between client and the valuer. All this generally is put under one management representation letter and you take that in the, for the file purposes. So again, that was also one of the challenges. In many cases, engagement letters details were not provided in the valuation report, which is also one of the requirements. In one of the cases where again for liquidation case, whether the valuer had visited the plant or not was not mentioned clearly. In one of the requirement is that suppose it's a valuation entity, registered valuer's entity. There is a requirement that contribution of capital of each partner needs to be mentioned. This was basically introduced so that what's your skin in the game. Some of the reports had this particular aspect missing in their reports. So these were some of the observations which came through. Again, peer review, in my view, will become more tighter and tighter. You will now see interform peer reviews also, which will get introduced soon. So we'll have to be more clear, careful about the requirement of the format of the report, requirement of the ingredients of the report, and prepare ourselves for those future scrutiny First, from our own professional brothers who will come as a peer reviewer, and second, if the luck is good or bad, with the from a regulator side. So that's where the field is as I mentioned is very progressive. You have huge opportunity lying in place, and particularly if those who are chartered accountants or those with financial background are at a much advantageous position vis-a-vis some other valuers category. So we have lots of opportunities available to us. At the same time, we need to also upgrade our way of conducting to make sure that we fit into the requirement which are put by the regulations, and we pass their test also of in terms of the quality requirements, so that the confidence of the Indian professionals also will be equally be confirmed by the global participants also, because our reports are also read. Suppose I issued a merger report where foreign shareholders are also there, so our reports are issued by read by the global firms also, and they also will go through this. So we have to also rise to the occasion. Again, not that it was not followed earlier, but we need to also be a little more careful to meet the requirement of the regulations. As I mentioned, just to end, this is an evolving field. We are yet to reach a matured space, but it's a journey which is a beautiful journey, and all of us will learn something new going through this journey. That's all from my side, friends. Thank you so much, and thanks the organizers for arranging this session.
Thank you so much, Sujal sir. On behalf of all the participants and ICI RView, we thank you for taking time out from your schedule for such an informative session, sir, that dwells upon overview of valuation, different work areas as mandated by various laws, and more so for sharing tips on how to be a good valuer based upon your vast experience. We look forward to more such sessions with you, sir. Thank you so much.
Thank you so much.